Hey there, everyone. Dave Keller here with Market Misbehavior. Welcome to my weekly show here on StockCharts TV. So glad you're joining me here as we analyze the markets using the power of the StockCharts platform. And today, we're going to talk about moving averages. We're going to talk about breadth indicators. And we're going to create a powerful mashup between those two topics, moving average breadth indicators. This is a set of tools that are available to StockCharts members that I feel are very powerful to help us answer or help us address three very important issues during a bull market phase. Number one, how can you confirm that a bull market is in a strong situation, in a healthy condition? And we'll talk about how the moving average breadth indicators can help us define that. Number two, what sort of warning signs can we detect during the end of a bull market phase to recognize that we're in sort of the later innings as opposed to the earlier innings of a bull market. Then we'll talk about how we can confirm that a bull market is, at or near an exhaustion point. What sort of breakdown signals these indicators can help us understand or help us recognize to differentiate between just a brief pullback within a bull market phase and something much more significant. Before we get to these powerful charts on the StockCharts platform, as a reminder, if you're looking for my market recap show, we live stream every weekday after the close at 5 p.m. Eastern, at 2 p.m. Pacific. That's on my YouTube channel called Market Misbehavior with Dave Keller. Check it out there. That show's called Chart This, and we love to recap the markets. And again, it's using almost entirely StockCharts capabilities to help you understand that. So don't miss that one. And also, our Market Misbehavior podcast, we've had some really fantastic interviews recently with Ian Reynolds, who is a market maker in London, and then a tech entrepreneur and a cryptocurrency investor. He had a lot of really good insights when I spoke to him last week about market conditions, about the Fed meeting this week. So many other great topics. Bob Pisani, I caught up with him a couple weeks ago with a fantastic discussion about his career on the floor of the New York Stock Exchange and some of the lessons he learned from some incredibly wonderful market practitioners that he's overlapped with. That's also on my YouTube channel and on all the podcasting platforms. All right, let's get to the charts here on StockCharts.com. We're going to start with just a daily chart of the S&P 500 with some moving averages, just to sort of set the table for this meal we're about to enjoy together, talking about moving average breadth. So here we're looking at the S&P 500 on a daily basis going back for the last 12 months. And then we have four moving averages: the 20-day simple moving average in blue, the 50-day simple moving average in red, the 100-day simple moving average in green, and the 200-day simple moving average in pink. Now, the reason why we selected these four moving averages is because StockCharts has some really cool breadth indicators based on these four timeframes. So if you can understand a little bit about what they tell us about market conditions, it's going to help the conversation a little bit later when we look at some of the breadth indicators based on these tools. So obviously one of the easy takeaways, if you're not big into moving averages, which you have to remember is a moving average is basically designed to smooth out the price action, right? So if you look at like the day-to-day movements from one day, from 1 week to the next on the S&P 500, even if the market is in a good uptrend, we have these big pullbacks, right? Even if the market is in a downtrend, you have these sudden upswings that occur. And even from one day to the next, we'll have gaps, we'll have big up days and down days, regardless of the larger trend. So moving averages are an attempt to kind of smooth out the noise, filter out the fluctuations that happen day to day, and just try to understand the trends overall. So a couple ways that we use moving averages, number one, we look at where the price is relative to the moving average. We'll come back to that. We can also look at the slope of the moving average, right? Are these different moving averages sloping upwards or downwards? And we can see most recently, of course, the 20-day, the 50-day, the 100-day, the 200-day, all sloping higher pretty much consistently since the, call it mid to late May, maybe into early June, late June for the 200-day moving average. So the shape of the moving average or the slope of the moving average can be very meaningful as well. Then people look at crossovers, right? When did these moving averages cross above or below one another? So for example, a golden cross when the 50 and 200 cross, if the 50-day crosses up through the 200-day, for example, often gets a lot of attention in the media. But that first one, which is comparing the price to the moving averages, is what a lot of moving average breadth indicators are based off of. And it's quite a simple comparison, right? Is the price above the 20-day? That's bullish. Is it below the 20-day? Well, that's bearish. Now, on what time frame are we saying that, right? If the price is above or below the 20-day, what does that mean? Well, the longer the moving average, right, the higher the periodicity, right, the more number of days we're incorporating into that moving average, then the more meaningful it is if the price is above or below. So if we're comparing the price to the 20-day moving average, then if we're above the 20-day on a very short-term time frame, what I call the tactical time frame, the price is bullish. If the price goes below the 20-day, it's bearish on that tactical time frame. We can see like back here in late October, early November of 2024, look at how the price went below the 20-day, but remained above the 50-day, the 100-day, and the 200-day. Look here in December into January, where we broke the 20-day, we broke the 50-day. We did not break the 100-day on a closing basis, right? We traded intraday below there. We didn't ever close below it. So we broke the first two moving averages, but we didn't break the last two. Then compare that to February, March of this year, where one by one, we broke all four of those moving averages, finally breaking below the 200-day in early March. So those three periods, right? This sort of late October where we broke the first moving average, mid-December where we ended up breaking two, and then February into March where we broke all three. That tells you the severity of the pullback. If we just break the 20-day but hold the rest, that's a brief pullback within a primary uptrend. If we break the first two but hold the 100 and the 200-day, that's a more significant decline. However, the long-term trend is still positive. If we break the 200-day, that means we've broken all four of them, and that means we're in a much more significant correction. The kind of correction that usually doesn't happen any more than once a year, and very, very rarely multiple times in a year. That's sort of like the big sell-off you probably want to avoid during a calendar year. So just by analyzing the chart of the S&P very quickly, we can differentiate short-term pullbacks versus more significant drawdowns based on how many of those moving averages that are broken. And it also helps us understand, like here, since May, right, when we finally broke above the 100 and 200-day moving averages, we've remained above most of them for that entire period. We've briefly broken below the 20-day simple moving average just 3 times here in the last 2 months. However, we've remained above the rest of those. So that tells us from the end of April, kind of mid-May on, we've been in a primary uptrend, a couple brief pullbacks, just enough to break that first moving average, but not to do anything more significant. So that really speaks to the strength of the market that we've observed here in the the third quarter of 2025. Just brief pullbacks within a primary uptrend. So that comparison that we just did, looking at the price and just answering the questions, is it above all the moving averages? That's bullish. Is it below all the moving averages? That's bearish. Is it somewhere in the middle? Then the question is, how many are we breaking, right? And that tells us the significance of the breakdown. That is the foundation of moving average breadth indicators. Now, to get to these indicators, a couple ways you can do it. The easiest way I've found is using the recently updated market summary page on StockCharts.com. This has been, I would argue, one of the biggest improvements I've seen on the StockCharts website, and I've used it for many, many years, going back to my days at Fidelity, where I would use it all the time as sort of a backup charting platform, and now I use it for almost all of my charting because the capabilities are that good. And the market summary page was one of those that I rarely use, but Grayson Rose and the team at StockCharts did a fantastic job just kind of redesigning this from the ground up. Grayson thankfully reached out to me last year when they were sort of in process, and I gave him some feedback, and almost all of which was incorporated into this new version. I'm so thankful for that. To get to this page on the StockCharts platform, you want to use these drop downs, and there's one called Market Analysis, and you want to pick the first one called Market Summary. Now, I will tell you right off, there is a lot of information on this page, so I'm just going to focus in on one particular area that has some breadth indicators I think are helpful. But that is not to say that the rest of this page is not incredibly valuable. I would encourage you strongly to take some time and review some of the different components. Each of these widgets is there for a reason. I will tell you, having gone through a bit of the design process, things aren't just there on accident, right? I mean, there was a lot of deliberate thought and intention about what was put where and what information was on there. And anything that seemed superfluous or unimportant was removed, and that was replaced with stuff that the stock charts team felt would help you really understand market conditions. So we've got charts, we've got equity indexes, market factors, looking at different types of stocks and themes. My market trend model is reflected in this Keller Market Models widget. This is my market trend model that I refer to all the time with my premium members at Market Misbehavior and certainly in my own work. Now we're down to some really cool breadth indicators. And again, there's a lot of more cool stuff below here. Maybe in future videos, we'll go through some of those other widgets in a little more detail. But we're going to focus in this section, particularly on the left side, called breadth. Now, there's three kind of sections here, and a lot of these widgets have a very similar format, so you get an idea of how the page works. This is looking at daily advancers versus decliners, how many stocks are up or down on a particular day. That same breadth is done at the sector level, which I found super valuable to see which sectors are showing stronger or weaker breadth on any particular trading day. But this third one is really powerful because this shows you, for the S&P 500 as well as a number of different indexes, what percent of their members, what percent of the members of these indexes are above their 20-day, 50-day, 100-day, and 200-day moving average. So on that previous chart, we actually did that analysis on the S&P itself, right? We looked at the chart of the S&P and we asked the question, is it above the 20-day? Is it above the 50-day? And so forth. But here we're actually doing that analysis on all 500 members of the S&P 500 and then showing you the percent that are above the moving average. This is a moving average breadth table. So we're going to look at this middle line, but again, you can do this similar analysis with the NASDAQ 100, with small caps using the S&P 600, even a huge universe like the S&P 1500, which includes large, mid, and small caps, all as one big index. But here, the S&P 500, you can see as of this moment when I brought up the page, just over 50% of the S&P 500 members are above their 20-day moving average as of September 15th. 59% are above their 50-day. And you can see that these numbers are both shaded kind of this neutral amber color. So there's a logic behind the scenes that just does a quick assessment. Is this particular value that we're showing neutral, bullish, very bullish, bearish, very bearish, and you can see the scaling from bright green to bright red and everything in between to illustrate that. So here we can see that the percent of stocks above their 20-day and 50-day kind of neutral here, but if you look at the percent above their 100-day, it's in a bullish green because it's over 65%. Stocks above their 200-day for the S&P 500, bullish green because it's at 64%. Now you can actually click on any of these blue links to bring up the chart. I brought up the chart just a moment ago so we could take a look. So this is basically the chart that is being used to fill in that previous table. So here's the S&P 500. We just looked at a kind of different version of this chart, looking at the daily S&P for the last 12 months, the 20-day, 50-day, 100-day, and 200-day. The colors are a little different. Don't sweat it. It's all a preference thing. You can make these look however you really want. Whatever's going to speak to you in terms of moving average coloring, you're welcome to change it. But these indicators here are the breadth indicators tracking the percent of stocks above those key moving averages. So these are the current values that you saw in that previous table. But by looking at it in a visual format, right, in a chart, we can now look over the last 12 months and actually see what the price has done or what these indicators have done. So we're going to look at the chart of the S&P here, and we're also going to compare it to some of the indicators on the top. And I'm zooming out a little bit just so we can look at all of it kind of together here. So here we're looking at the chart of the S&P 500. We've highlighted in on that October period of last year where the S&P broke below its 20-day moving average but held the rest of them. We can look up here and see that at that moment, right, which was around Halloween of last year, I'm actually going to zoom back in just because I want to see it a little bit bigger. We can see that at that point when the S&P broke below its 20-day moving average, most stocks in the S&P 500 did the same, right? You can see that only about 32%, we'll call it, of the S&P members, about a third, remained above their 20-day moving average at that particular point. It was about a coin flip, 50-50, as to how many stocks held their 50-day, even though the S&P definitely did. And then obviously well above 50% held their 100-day, and well above 50% held their 200-day. So that really spoke to, the breadth indicators showed a lot of short-term weakness with a lot of stocks breaking their 200-day, kind of half and half holding their 50-day, but most stocks holding their long-term moving averages. So the fact that most stocks remained above those long-term moving averages, as the S&P did, tells you that the market remained pretty much in a position of strength. Now, fast forward to what we see here. This is at the February market peak. We can see this was a previous period that we looked at on that last chart where we broke below all four moving averages, eventually breaking below the 200-day moving average there at the beginning of March. If we go to the top here, we're sort of looking at these same indicators here. So compare that first period to what we saw here coming after the February peak. Look how all of these broke below 50%. So just as the S&P was breaking its 200-day moving average in early March, most stocks in the S&P 500 were also breaking their 200-day moving average. And in the end, it was only 20% of the S&P members that actually held their 200-day moving average at the eventual low in early April. So by looking at these breakdowns in the breadth indicators, you'll see that the 50% level is kind of a good basic assessment. For each of these, I like to just review. Is it above 50%? That's bullish. Is it below 50%? That's bearish. There's probably more nuance than that, but as an initial assessment, that's how I like to use this as a kind of a quick checklist. So at this point, right, really bullish at the end of February. You can see at the beginning of January. At the beginning of February, we can see these indicators start to roll down. We can see that we break below 50% here first, then we break below 50% here, and then we break below 50% here, and then finally the percent of stocks above their 200-day finally breaks below as well. So this is sort of the market at an exhaustion point kind of red flag that we would be looking for in this current environment. Note at this point that we're over 50% on all of these indicators as of last Friday. But this is what would be a concerning development, is if these lines would start to rotate below the 50% level. And as we talked about, above their 20-day moving average, that's more of a tactical short-term read. Stocks above their 200-day moving average, that's more of a long-term read. So the way that these charts would turn is that the percent of stocks above their 20-day would probably break down, almost always, if not always, break down first, and then it would be followed by the rest of these. So if only the first one breaks and the rest hold 50%, we're in a tactical pullback. If they all start breaking down, that tells you we're in a much more significant decline. And when the market really starts to roll over, I always focus on this last one, right? And if we can hold the 50% line for the stocks above their 200-day moving average, conditions just aren't getting that bad. But when it's broken, as it did in early March of this year, that's when it tells you really want to be thinking defensively if you're not already there. So with that as sort of a brief history lesson on the last 12 months and how these breadth indicators reflect the changing conditions of the members of these indexes, let's look at what's happening right now here in September of 2025. You'll probably understand why I'm sort of in a everything's good kind of environment according to this particular set of breadth indicators, in the fact that we were remaining above 50%. Now, the percent above their 50-day, as we're recording this episode, is kind of actively right at the 50% level. So let's keep an eye on that, because if it would break back below 50%, that would tell us maybe we're in a short-term pullback scenario, or at least a lot of individual stocks are starting to break down a little bit. But as long as the rest of these hold 50%, conditions are still pretty good. If we would see one by one these break the 50% level, that would be concerning. For now, they're still well above that 50% threshold, which tells me that overall, any movement we're seeing right now is more noise until these start to break the 50% level. Another thing I would tell you, and this is one of the ways that I love using these indicators, is to look for divergences, all right? Look at the S&P 500 in January of this year, and then look at February, right? So we did make a brief higher high. This is when we touched 6150 for the first time, after we broke above 6100 for the first time. In January, we just teased the 6150 level here in mid-February. That ended up being the peak for the first quarter, and really signaled the rotation lower soon after to get down to that early April low. While the S&P was making a new high, look at these indicators that were all sloping lower. Percent of stocks above their 200-day moving average sloping down. Percent of stocks above their 100-day sloping down. Above their 50-day, sloping down. Above their 20-day, big time sloping down. So think about what that means, right? The S&P went slightly higher, but we were at 80% above their 20-day. And then at the all-time high, we were below 50%. So what that means, and the reason why there's that divergence at the major peak, is often at the end of a bull market phase, the index keeps making new highs, but breadth indicators like this start to slow down. That's because there are some stocks within the index that are no longer making new highs, and they're actually starting to break down a little bit. And so that divergence, that bearish breadth divergence, can often be a really powerful indicator of a market sort of in the later innings, like 8th or 9th inning of an uptrend, as opposed to the 2nd or 3rd inning. Now, what concerns me about the market here in September of 2025 is we're seeing a lot of those very similar divergences, right? Look at how the S&P has made a new all-time high from late August to now mid-September, with the S&P trading above 6,600 as we're recording this on Monday, September 15th. The percent of stocks above their 200-day has been sloping downwards over the last 3 weeks. The same for the stocks above their 100-day, same with the stocks above their 50-day, and very much the same with the stocks above their 20-day. And it's actually very similar to what we saw at that February peak, right? Remember back here we had 80% in late January, and then we were down to below 50% at the February peak. We're actually seeing a very similar scenario here over the last 3 weeks. Here in mid-late August, around 80% of the S&P above their 20-day. Now we're right at 50%. So what concerns me right now is the early warning built into this indicator. The divergence seems to be firing very clearly, right? We're making new highs, but instead of more and more stocks pushing above those key moving averages, we're seeing less stocks push above their moving averages. So the early warning is checked off for me. The red flag is waving a little bit. What would I be looking for using this chart? Quite simply, if this stock's above their 20-day, this top series can hold 50%, then this is all more noise than anything, right? Until we start seeing a breakdown there, it's not the end of the world. But if this divergence plays out and we start to see these indicators break below 50%, especially this very important stocks above their 200-day, that's the longest version that we use. If that would break 50%, that would confirm most likely a bull market top. For now, early warning, we'll use this chart and continue to reflect on it to see if we get those changes. I hope this helped, right? As we talked about some breadth indicators, particularly moving average breadth. As a reminder, you can get to that chart on the market summary dashboard. We'll include a link below this video to get to that market summary dashboard, as well as this particular chart that allows you to analyze those moving average breadth conditions over time. What we did was a brief history lesson, looking back at some short-term peaks in 2024 and then the top in early 2025 to see how some of these breadth indicators evolved, and then compared it to what we saw now. Remember, charts provide a fantastic history lesson, and as a StockCharts member, you have access to some pretty cool historical data to look at previous market tops, not just in the last 12 months, but in the last 12 years and beyond. So always a good time to be a StockCharts member if you're not already. As a reminder, if you're looking for my market recap show, if you want help tracking charts like this and how they evolve day in, day out, for early warning signs as I review them in my own process, you can find that on my Market Misbehavior YouTube channel. So please tune in as we live stream every trading day at 5 p.m. Eastern. Also, don't miss the latest episodes of the Market Misbehavior podcast. You can find that on my YouTube channel. Also on all of your podcast platforms like Apple Podcasts, Spotify, and wherever else you listen to voices like mine. That'll do it for today. Thanks so much for tuning into my show here on StockCharts TV. I wish you a fantastic Fed week and wish you all the best. And in the meantime, remember, it's always a good time to own good charts.